Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. It's the start of the week, so we have a very economic-heavy video for today. Over the weekend, Caixin Insights Group published its so-called Caixin China General Services Business Activity Index, which seeks to provide an independent snapshot of operating conditions in the services sector. According to the index, activity in China's services sector expanded marginally faster in October than the previous month, but was still the second weakest pace this year. Quote, as growth in new orders softened amid weaker business confidence, end quote, in the words of the note accompanying the survey. As we can see, the index rose to 50.4 from 50.2 in September. A reading above 50 indicates an expansion in activity month on month. Last week, the National Bureau of Statistics published the official services PMI, which fell to 50.1 in October from 50.9 the previous month. We remember that analysts were somewhat surprised by the drop in services and very much surprised by the contraction in manufacturing. The sub-indexes showed that total new orders received by service providers in October increased, but at the slowest pace this year, quote, despite better external demand. End quote. They also showed that companies turned more cautious on hiring and expansion in employment, quote, ground to a halt in October, ending an 8-month streak of growth, end quote. Regular viewers know, of course, that youth unemployment remains stubbornly high, at officially over 20%. Business confidence was also poor in October, according to the index, with the gauge of future activity dropping for the 4th straight month to its lowest level since March 2020, when the country went into its first national lockdowns. Wang Zhe, a senior economist at Caixin Insight Group, explained with the slowdown, quote, the economy has shown signs of bottoming out, but the foundation of recovery is not solid, end quote. Adding, quote, policy-wise, China has rolled out measures to stabilize market expectations and boost consumption and investment. More recently, it has decided to issue an additional 1 trillion yuan of treasury bonds to support post-disaster reconstruction and enhance the capacity of disaster prevention, mitigation and relief. This will facilitate infrastructure investment and help stabilize the economy, but its impact on improving household income, employment and expectations remains to be seen. End quote. One day before the publication of the Services Index, Caixin Insight Group also released its so-called New Economy Index, which seeks to use big data to track the size of China's nascent industries. It measures labor, capital and technology inputs in 10 emerging industries relative to those used in all industries. According to this index, the contribution of high-value added industries, such as biomedicine, to China's total economic inputs dipped in October as labor, capital and technology inputs all declined. The New Economy Index came in at 31 last month, down 0.9 points from September, quote, indicating that new economy industries accounted for 31% of China's overall economic input activities. The reading marks the first drop in 4 months, end quote. The technology input subindex, which accounts for 25% of the total index, dropped 1 point to 26.9. The subindex for labor inputs, which has a weighting of about 40%, fell 0.3 points to 22.6. Next up, the Macau Special Administrative Region may finally be seeing some light at the end of the tunnel after years of its main industry and local government revenue being battered by zero COVID restrictions. According to data released by the Gaming Inspection and Coordination Bureau of the Special Administrative Region, casino revenues, that is, gambling revenues, in the city grew 400% year-on-year to $2.4 billion in October, bringing the world's largest gambling hub's gambling income to 74% of its pre-COVID levels. This was driven in large part from visitor inflows from the mainland during the National Day holiday in early October. This is a positive sign for the local economy and government fiscal health, both of which rely heavily on casino revenue. However, being still only 74% of pre-COVID levels demonstrates that the Special Administrative Region still very much has some pain ahead of it on its hoped road to recovery. Next up, we now need to touch on the more concerning developments in regards to the economy. Hey everyone, if you enjoyed today's episode or getting some value from it, don't forget to hit the like button. Sharing with people who you think would also get some value is one of the best ways to help the channel grow. And for those who want to go the extra mile and help me keep the channel financially sustainable, open and free for everyone 6 days a week, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. We now move through more economic updates. Chinese financial media outlet Yicai reports over the weekend that China's local governments have issued 8.5 trillion yuan, 1.2 trillion US dollars worth of bonds so far this year, reaching a new record and exceeding the 8 trillion yuan mark for the first time ever. And this comes as the central government becomes increasingly concerned about the slow-moving crisis, which is local government debt and fiscal conditions. Indeed, an unnamed source attending the two-day National Financial Work Conference last week, for example, told Hong Kong-based South China Morning Post, quote, "The conference will primarily focus on resolving debt. At the moment, the most important thing is to resolve the debt problems, of which the core is the fact that local governments are out of money." End quote. Before the COVID-19 pandemic back in 2019, Yicai explains, local governments sold about 4 trillion yuan of bonds a year. Quote, "with that soaring to a record 7.5 trillion in 2021 and 7.4 trillion last year." End quote. That is to say, the rate of debt accumulation from local governments has doubled since before the pandemic. More concerningly is where raised funds are going. Proceeds from the sale of special refinancing bonds, instruments employed by local governments to repay part of the principal on maturing local government debt, surged this year too. According to official numbers from the Ministry of Finance, local governments repaid 3.2 trillion yuan of debt principal during the first 3 quarters of this year. Quote, 89% or 2.9 trillion of which was repaid with the proceeds of new financing bonds, showing that these authorities rely heavily on borrowing to repay debt. End quote. Remember, this observation is being made by a Chinese financial outlet itself based on official government data. These are not Western journalists trying to push an anti-China narrative. We also remember that the week before last, the National People's Congress approved the issuance of additional sovereign debt worth 1 trillion yuan. That is, the central government is providing direct fiscal support to some localities on top of these refinancing bonds. Jiang Jun, chief economist at China Galaxy Securities, told Yicai, quote, "The extra 1 trillion yuan issued at this point of the year can help local governments make up the fiscal gap resulting from lower income from the auction of land use rights." End quote. This is significant as it demonstrates that the lacuna in already highly leveraged local government finances is not due to fiscal holes in the regular budget, lower tax revenues for example, but rather due to a fall in extra budgetary income from land use sales tied to a housing sector currently in crisis and unlikely to return to pre-crisis dynamism and growth. All of this reminds us once again just how concerning the local debt situation is. Yicai, in a separate piece, reports that the central government is also expected to release next year's local government bond quotas before the end of the year. Quote, "potentially as much as 2.3 trillion to ensure that local authorities can quickly promote investment in relevant projects and maintain the strength of fiscal stimulus." End quote. And finally for today, over the weekend it was confirmed that Gallup, the Washington-based polling and consulting group, which first came to China back in 1993, is pulling out of China due to concerns of safety in the current political climate. UK-based The Financial Times broke the news over the weekend, citing 3 unnamed persons and documents seen by the outlet. In a private message to clients, Gallup reportedly expressed, quote, "regrettably, Gallup has made the decision to close its operations in China," end quote, closing its 3 offices in Beijing, Shanghai and Shenzhen. The Financial Times writes, quote, "US consultancies have been struggling to attract business in China. where a broader economic slowdown has been compounded by state security agencies scrutinizing the consulting industry over concerns that sharing data with foreign companies could jeopardize national security. End quote. Back in March, the state-run Global Times accused Gallup of, quote, serving as a tool to contain China and maintain US dominance, end quote, after a Gallup survey showed that US public positive feelings towards China was at a record low. These sorts of comments from popular state-run outlets are no doubt weighing on the minds of many other Western or foreign companies concerned that their employees and operations may not be entirely safe in the current political environment. And of course, Gallup is just the latest US consultancy to leave China. Chinese security bodies have raided US consultancies such as Bain & Company, due diligence group Metz, and expert network provider Capvision in recent months. The scope of so-called national security rules to protect data has also greatly expanded this year. Gallup is the latest foreign company to retreat from China, but it likely will not be the last. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week ahead, and I will see you all tomorrow.